Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It will help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Nick Smith. Nick is the author of what I believe a fantastic private credit Substack or blog, The Credit Crunch. If you're not yet a subscriber, I do recommend that you subscribe to his newsletter. I will link to it in the show notes if you don't know the website off the top of your head. Nick, it's really, really great to see you. Thank you for coming on the show and spending a few minutes with me.
Great to see you too, Todd, and thanks for the invite.
I think starting at a bit of a high level, I think a couple of your recent newsletters certainly covered kind of what's happened in 2025, what's some of the themes going into 2026. And so starting with that, how would you kind of define where private credit is today and the various kind of strategies that fit under the broader private credit umbrella?
Yeah, it's a good question. It's also sort of a tough question, right? So I think I think it's out of all the markets, I'd want to be in private credit, right? I think or credit more generally. I think
Yeah.
what we've seen it's a tale of two halves, and I think there was a really good Hamilton Lane article that really summed it up in the middle of last year. It's basically just like we're going through this weird transitional period where private markets haven't been able to get liquidations as quickly as previous years, right? And so when you look at it from a private credit standpoint, it's better than the private equity in terms of
Yeah.
you get your yield, you get your payments, you pay them back to your LPs. But it's not like we're in terms of that flood of M&A, which we definitely need for the direct lending market. That hasn't been there, right? And so fingers crossed, 2026 looks like the year that the deal dam is breaking, and then you can suddenly get all of, as soon as that direct lending can come back, then I definitely say it's a really exciting time for private credit.
Looking at some of the fundraising coverage that you've had in your newsletter, it looks like it's still dominated by a lot of the larger, more well-known established funds, large funds. I mean, is that is that trend really stopping anytime soon?
Not anytime soon. And I think that's quite an interesting point. So I think if you looked at it last year, existing managers counted for 98% of all fundraising. Um, and we're going through this phase where what I think is quite interesting and when you speak to big pension funds, LPs, um, they are focusing on their existing managers. And they might be increasing. I guess if you looked at all of my fundraising last year, most of the private credit funds raising new funds were raising bigger funds than previously. And then so you start questioning, well, private markets, private credit last year didn't actually increase by that much. I think it was like 8%. So how is this so if every fund is, and so fewer funds are being raised
Yeah.
and LPs are focusing on their best credits and that's it. And this wave of additional capital to private credit is coming from other areas of asset allocations. Is coming from your private equity buckets. It's coming from maybe from your traditional fixed income buckets, right? Your public credits. But it's not suddenly opening up this gateway for new managers. We just haven't seen that. And I think that broadens into the bigger picture here of just like risk off. And if you're an LP here, and I think it's quite easy. I was talking about this with a colleague the other day of like you can picture these LPs as these like magical people out there with all the power and wisdom. But actually they're just employees, right? And so
Yeah.
when they're going to their investment committees and the consultants are recommending something, they're going to stay safe. They're going to pick existing managers that have proven track records, especially in this risk-off environment. And so I think like any market, it's really tough to break into.
Is that is that healthy for the market? I mean, it seems like there's, a lot of concentration amongst obviously the larger names, and
Yeah.
if there is the proverbial event, is it a good thing that so much is just concentrated near the top?
Yeah, I don't know. And I think it's I don't think it's and maybe this is just a state of where we are in this in generally, right? So if you look back 40 years ago when private markets were more of a cottage industry and as they've become more institutionalized, that always going to happen. Every market is going to get more concentrated, right? You can say the same thing about um, the US stock market, right? You have a concentration of
Yeah,
seven
that's true.
stocks. And so concentration exists everywhere. Um, and I think when we fundamentally break down to what we're looking at here, it's people's pensions, it's people's wealth, everything is tied. And so you have to trust these people. The last thing you want is someone coming with no track record and investing that money. And so that's of there's but then obviously there's always needs to be competition. And that's always the interesting dynamic. And I think, to be fair, with the top eight managers, you probably do get some form of competition. Um, I joke because if you looked at all the large managers, they all have the same strategy, right? Everyone wants to double in 5 years, and they're all trying to eat. And hopefully, the market does double in 5 years, and there's enough.
Yeah.
But everyone is very ambitious. Everyone's chasing it. So there is still that degree of competition. It's not like it's collusion and everyone's sitting back.
What about the dynamic of, kind of your more generalists versus, those that are, a bit more specialized? I know I saw, the fund of the year you had, was KSL's, fund. Maybe talk a little bit about that, why you selected them, and then what about that generalist versus specialized dynamic?
Yeah, absolutely. So yeah, first of all, I went through I had a 300, 400 fundraisings last year and I went through and picked my favorite. And that was the KSL TAC Hops 2 fund, which fundraised last year. And I think like I said, I picked this one for three reasons. It's an interesting and it touches kind of on what we had just said earlier, Todd. So one, well, first of all, it's we've seen this massive movement away from direct lending, and the direct lending market at the moment is just a commodity, right?
Yeah.
If especially with M&A going down, the competition is huge, right? And most of this competition is just refinancing. So without the M&A market, well, without the M&A market, the only way to lend more is just go and either lending to existing clients or try and refinance someone else. And then, so as a result, you've seen the direct lending market shrink. And so, where is that opened up in terms of where have people, ambitious managers, gone to grow, and what opportunities have? And that this is, like I said in my newsletter, 2025 to me was the year of the opportunity fund, and this is kind of where it links in. And so everyone knows, and I'm not sure. Have you heard of the K-shaped economy?
I have. I don't know if
Yeah.
everyone knows exactly what that is,
Yeah.
listening,
So
but I'm certainly aware of it.
yeah, absolutely. So maybe what we can do after this is you can link Marblegate really summed it up really well. And I'll link to the Marblegate summary. But I think what we're looking at here is global economies, it's a tale of two halves, right? And so you're either in a business that's doing really well, growing, and taking up, or you're in a business now which interest rates have risen. Um, it's caused some pressure on your consumers in some way, and your actual earnings of your business have declined. And what we've seen is across all the economy with declining earnings has put pressure on those companies to pay back their debt.
Yeah.
Right. At the second time, interest rates have risen, right? And so not only have to pay back their debt, but they also have to do with increasing interest. And so
Hmm.
you have these businesses that just can't afford the level of debt that they previously borrowed. And this is amazing for all these opportunity funds, right? Because it just causes the time and a moment where these businesses are fundamentally, they have a reason to exist, but they've just over leveraged. And so your traditional direct lending, which relies on, hey, pay my interest, pay my principal, that doesn't really work anymore, right? These businesses are not just your typical um, 4x EBITDA, let's lend, it's four turns of leverage, right? These
Yeah.
these businesses need some sort of difference. And that's why opportunity funds, I feel like, has massively grown in the last couple of years because they have the mandate to be different, right? You can take some sort of risk of in between that interest rate. So what they've done in terms of the opportunity funds is you can take equity, you can take preference shares or somewhere in between, right? And so that way you can really work with these borrowers. And so the opportunity set of these borrowers, the market has really grown over the last 2 years. And that's why it's exciting for all of these opportunity funds going. I just want to stress as well as these aren't distressed lenders. These are just one point in time. We've never really had this moment in time with private credit before because private credit back in 2007 was a far smaller beast, right?
Yeah.
Um, and so this is an exciting time. And so KSL, if you look at it as a manager, they focus on travel and leisure. And so if you just think about this specifically or just generally, travel and leisure is an industry that everyone thinks is cyclical, right? And if you
Hmm.
look at most managers, they stay away from cyclical industries. And so if you just look at KSL, they're like, oh, that's nice, but I'm not touching that market. But then you drill down, and I think this is quite interesting. Um, I think Aries in terms of in the gaps have a really interesting quote when in terms of, and I really like this. They wrote this last year as generalization errors catch the unwary investor too focused on the big picture and not enough on the details, right? And so that's an interesting point. So with KSL, it's very apparent, right? Like they don't focus on travel and leisure generally. They focus
Yeah.
on a very specific consumer. And that's those consumers are the top 10% of earners. These people spend 4 times as much as the average consumer, and they really value. And so it is not a cyclical consumer or cyclical businesses that focused on. They're very specialist businesses. And so that's why I really like KSL as a manager, right? Because they are counter positioned. And as a result, what they've done built up, and KSL hasn't just isn't just they've been around for a very long time. I think it's 30 plus years. And over
Yeah.
this time, they've invested in 200 companies. And then what you learn is because of all the knowledge across the sectors, no one else can compete with them to win these businesses, right? They have 50,000 employees, 30,000 skiable areas, 7,000 marinas, and 1,300 resorts. And so what you do is you create this amazing network of knowledge within KSL as a manager that no one can else compete with, right? If you're going to go bid on an asset and you've got your
Yeah.
generalist manager on one side and you've got KSL bidding on the other side, who would you rather have as a partner, right? They can
It's not even
introduce you.
close.
Yeah, exactly. Absolutely. So it's amazing thing is as they've built up this track record over time, is it becomes even harder and harder to compete with them.
It's
Um,
interesting that the way you phrased it there in terms of how they looked at the industry. They didn't look at it as the industry. They looked at it as the consumer who spends on the industry. It's kind of the opposite way of looking at, oh yeah, vacations or leisure is cyclical, but not to this consortium of consumer, it's not cyclical.
yeah,
And so I
absolutely.
think that's the more interesting way they've looked at it is, hey, we're not going to look at it as a leisure play. We're going to look at it as a consumer spending play, and this is what they spend on and how much they spend on it, and it's not a cyclical market to that consortium of consumer.
Yeah, absolutely. And I think that's one of the things you've hit the nail on the head, Todd, in terms of what I've seen of all the really good managers at the moment. They're focusing on the consumer, right? Focusing on those cash flows because that fundamentally is what pays our credit.
Yeah.
And if you lose sight of these businesses and focus on, hey, this is just a revenue line and this is an EBITDA line, then I think you lose sight of fundamentally what you're looking at. And again, going back to my point earlier about the K-shaped economy, you have to really understand where that business is. And we're going to see more and more of this over time. And I think it's just taken a very long time for these businesses. And you see it a lot in the UK, more and more so of these businesses every year that are going into administration, into bankruptcy. But they weren't a shock to anyone, right? I think you probably have it in the US every year of some person, some new retailer filing chap for a Chapter 11 or
Yep.
going bankrupt, right? And everyone will look around and be like, oh, that's a shock. But you haven't been there for years. You haven't
Yeah,
shopped there for
exactly.
years, right? And so I think we'll see more and more of this over time.
Yeah, the other thing I found interesting and something we hear all the time, especially the last say 6, 8, 10 months, is the proliferation of evergreen funds.
Yep.
And so maybe talk a little bit about that in terms of, what are some of the numbers you've seen there, and are all evergreen funds, equal specific structures within the evergreen market that are seeing greater traction? What's going on with evergreen funds that you've seen?
Yeah, absolutely. So yeah, with the evergreen funds, it's just another example of the evolution of our market. And and you've seen the typical fund structure that we've started, and this will happen across all. It's just the maturation of private markets. And so typically we started these um, fund structures with 10-year lives, and you would just go through it and you'd persuade investors and they'd move away. But as the industry has matured and people realize that private credit isn't going away anytime soon, the trust grows. And then the question becomes and there's lots of interesting insights on this of, okay, well, why do I have to give you my money and then you give it back to me, but I'm never fully invested, right? If you look at your typical private credit or private equity fund, and then have a look at your commitment, how much is fully invested at all times, it's really poor, right? And so
Yep.
then there's two aspects there. One is your IRR is not quite the IRR you receive, because if I commit 100 million to your fund, but um you've only drawn 50% of that, I'm not holding just that. You still have to hold that other 50% somewhere, right? So no one's looking at the cost of that cash. And this is where the evergreen funds become interesting, because one, they allow large pension funds or ultra high net worths to be like, I'm fully allocated at all times. And then you can decide what to do with your cash, right? You're not just waiting for it. Um, and the interesting dynamic of this, I think we will see more of this. But I don't think it's going to be on the lower end. I think this will be dominated by the large five managers. So this will be Apollo, Ares, Blackstone, KKR. These sort of people will go after the insurers, after the large capital, um, and maybe over time it'll open up to the smaller managers. Um, but I think that market will predominantly be for the likes of insurers.
And then, looking into the other push that people are having, which is into retail.
Yep.
Obviously, today's retail opportunity is high net worth, wealthy individuals. But do you see the retail opportunity going even beyond that to, everyday retail, 401ks? I know there was a push here in the US to start looking at 401ks and how they can get access to private markets. I mean, where do you see some of that playing out? Do you think it goes all the way down the chain to me or you or, my wife, and access to these some of these structures, or is there kind of a limit to maybe how far down the spectrum some of these funds might go?
Yeah, and again, so maybe I should have pointed out Mark Rowan at Apollo spoke at the Goldman Sachs conference last year, and he's talked about the evolution of private markets and the five stages. So first of all was the institutional capital, right at the bottom, and then you build up, and then you go on to the retail and wealth. So that's the ultra high net worth that's been around for a while. Then you move on to the insurance capital. And then there's these two new markets that we're talking about at the right at the top. So one is your traditional asset managers, like BlackRock acquiring HPS,
Yep.
and they're saying, "Hey, listen, I've just been doing typically, I've just focused on public markets, right? The issue with I have with public markets is the fee has gone to zero, right? No one, if S&P 500 ETFs, you're not paying anything, right?
Yeah.
And fundamentally, BlackRock exists to make a profit. So where can I make more money? And if you look at the profitability of private markets, significantly higher because it's more complex at the moment than public markets, and the competition is relatively lower compared to the public markets. So then the traditional asset, and you'll see more and more of this. So the traditional asset managers, like the likes of BlackRock, really coming after private markets. And then the final stage Mark talked about was the pensions. And this is exactly what you're saying here. It's the 401ks, it's the LTAFs in the UK, more and more of these legislations. And there's an interesting thing here is one, it's just a natural progression, but also it's typically we've seen a market where private equity, people like yourself and myself haven't benefited from all of these great private equity returns.
Yeah.
Um, and as the public markets become more and more concentrated, and as fewer, like if you look at the number of businesses going public, it's declining every year, right?
Yeah.
And people are choosing to stay private for longer. And so if you look at it, this progression is only a good thing for the likes of you and me because we have the choice to to benefit from the rise of these private investments. And so that's, I think, more and more legislation will come in for that exact reason, right? To make sure that the wealth doesn't become even more distorted, which it will do, right?
Yeah.
The issue on this point is the likes of you and me, we need to really understand that private markets are generally illiquid. And I know you get a lot of the large managers like Apollo's trying to come up with liquidation products and things like
Yeah.
this. But you see some pullback. So for example, Blue Owl earlier last year, I'm sure you caught up on it in terms of trying to merge a couple
Yeah.
of BDCs, and that caught them out, right? And so I think it's private markets liquidity will always be an issue, and you need to really focus on long-term horizons. And so for the average consumer who's not an alternative, I think the issue will be the liquidity.
Yeah. Agreed. And I think it's something that they'll have to certainly figure out how to solve for at some point in the future. You know, a few other things that caught my eye in some of your recent newsletters. One, the phrase that you had mentioned, the rotation into private credit and the rotation out of private equity. What do you mean by that dynamic? I know thus far we've obviously focused a lot on private credit in this conversation, but that certainly stuck out when reading some of your recent issues.
Yeah, absolutely. And this is just fundamentally in terms of there's a number of things going on here. One is interest rates have increased. And so when you look at all of where all the allocators have come from, they have typically what a 6 to 7% hurdle rate. And when rates were low as they were before in the era of free money, they couldn't allocate all of their money to private credit, right? Because you're yielding what all in probably 6 to 7% net. That's not really covering it, right?
Yeah.
But now with interest rates gone up and hopefully they'll stay up for a bit longer. I know spreads have really come in. You can yield 8 to 9% quite comfortably, and that covers most of the hurdles, right? And so fundamentally for all of these investors, why wouldn't I allocate more in private credit? Because I'm going to get my return, and
Yeah.
and that's one of the thing. And so the second point on here is private equity is going through this period where you've given them your money and it was based on, hey, here's my 2 to 3x multiple. But that 2 to 3x multiple and the return, the IRR, is based on a time horizon. And what we've seen is that time horizon has shifted. And
Yeah.
so then the question then becomes is, okay, well, what's my actual IRR when all of this plays out? And we still haven't seen that, right? And so the interesting thing there will be is, okay, well, previously maybe I'd got used to the 15 to 20% IRR for a private equity business, but is that the case now, right? And more of that will be, okay, well, is it 10 to 15? And maybe there's a lot of dispersion at that level, right? And so maybe it's very close. And so if you're in private equity and you're getting 10% and you're in private credit, but it's more liquid and you're getting your DPI a lot quicker and you're getting 8 to 9, maybe the risk isn't there, right? And so
Yeah.
what we're seeing is more of this, and Apollo are big on this, and actually it's not it's a shift in mindset. As long as the rates stay this is okay, well, maybe I should change that percentage of allocation from private equity to private credit.
The M&A gridlock. You had mentioned maybe it's the dam might be breaking. You know, at the same time, it's also led to, I think, the proliferation of some kind of cascading markets from the M&A gridlock. You have private fund finance has kind of taken off, providing either liquidity or financing options for funds. You have continuation vehicles, secondaries. So there's been some, I guess, byproducts of the M&A gridlock, but we do need the dam to break eventually. So is that dam breaking in 2026? And then does fund finance continuation vehicles, like, do some of these options become less appealing if the M&A market really takes off?
Yeah, so I won't comment on if it is definitely breaking in 2026, right? I think people were saying this since 2023 that it
Yeah,
was going to
exactly.
happen, and it feels like one of those things that you continue. So I don't know, but I think the interesting thing here, and if you looked at a couple of my articles last year talking about this gridlock, it is fundamentally that people have bought these assets and they have them marked higher than what people who have started new funds are wanting to buy,
Yeah.
right? Valuations just come in. But what we're starting to see is that gap is narrowing. One is people have lowered the marks, and two is people have money and they need to put it to work, right?
Yeah.
And so there will become more of this excitement of saying, okay, well, I need to invest. Um, the companies, I think fundamentally the companies that are growing, they will be M&A. Growing companies that are showing some profitability will continue to be bought and sold, and the competition will only get higher for those assets. It's these
Yeah.
businesses that are in the middle, right? And this is the opportunity for all these opportunity credit funds. And that's again maybe the shift from, like I said, from equity to credit, right? And so on the other angle, you have all these private equity buyers who've held these assets and just want to get rid of them at some point. And you have, or they want some sort of liquidity. So your
Yeah.
opportunity funds come in and do some sort of combination of maybe there's a secondary and maybe there's a cramming down of some of the equity. I think we'll see more of that in 2025, 2026, sorry.
The other thing I wanted to touch on before we get to some fun questions and wrap up in a few minutes is the risks and kind of the investments being made into data centers. It seems like, I know that you had put in a chart in one of your recent issues. I think it was an Aries chart. It seems like there's maybe a bit of a misalignment amongst investors, or the types of investors maybe trying to jump into this space, or not the right type of investors. Kind of, where are the risks around data centers? Because the other piece you have, it's like there is no real historical data. Data centers aren't like 50, 60 years old where you can look at like, oh, here's how they've performed. And then you have on the other pieces this rapid pace of innovation that we're, DeepSeek has thrown everyone into a spook. Like, can you do things faster? Chips are being made better. Like, it seems like there's just this kind of misalignment happening in the data center space. And it's going to be interesting to kind of see where that plays out.
Yeah, absolutely. And that's it was actually so a ton. There's a ton of really interesting stuff on this, and I think it's the people that have been around a while, are probably being the most cautious, but also it's the most interesting how it's working, right? So so Apollo had this really interesting piece on. Actually, it was at a conference they were speaking about it. It's just, there's a difference between the principal and an agent, right? And if you are the agent trying to be the broker and selling these deals going on, you just want to get your fee and then you move on, right? And you don't
Yeah,
care how the asset performs. Kind of how the housing crisis in 2007 went,
exactly.
right?
Yeah.
Yeah. And then you have the principal, and the principal needs to have faith that one, that I could pay back, and two, that someone's going to refinance me at the end. And it's a really interesting point here because your largest buyers of this, your Microsofts, your Amazons, your Metas, um, they are highly they're almost better than governments, right? So the big managers leasing to these, I don't think there's going to be an issue, right? Investing in a data center to Microsoft, I don't think fundamentally,
Yeah.
but your yield's not there. It's all of these new players that are trying to come in and trying to start, and there's a lot of them, right? And a lot of people getting excited and saying, okay, we're going to do this and we're going to start our new data center and then we're going to lease it to Microsoft afterwards. That's where the issues will come because you have to have faith that they can get the data center built and there will be the demand for that data
Yeah.
center. And that's the risk, and that's not that's a different type of risk that I don't think everyone is factoring in. Um, and then there's the other thing is that's quite interesting. I'm sure you might have read it. Is Howard Marks' recent memo called "Is It a Bubble?" and and the really interesting point on that was when he was saying, okay, well, if I look at the railroads in the US, they transformed the US, but there was a bubble, right? There was overinvestment. If
Yep.
if if I looked at electricity, electricity transformed the US, but it was a bubble. And then it fundamentally, like more closer to home, if I looked at the internet transformed the US, but there was a bubble
There
in
was a bubble.
2000. Yeah.
Exactly.
And so if we looked at AI is going to transform the US and it's going to transform the globe, but the chance of it happening and there not being a bubble is quite low. And so then the spectrum becomes on this point is okay, what risks am I taking? And who are the winners and the losers of this, right? And I think we're starting to see it. I think you mentioned, Todd, separately, not just data centers, it's everything around data centers. And more we're starting to see this creep in of hey, this is my business and I'm going to bring AI in. And you get
Yeah.
this multiple, right? And more of the
Yep.
VC stuff, and it's closer to my world, right? I'm in venture debt. More and more you're starting to see these businesses. Um, but I don't think I think most of them just will not be successful, and that's a different type of risk, right?
Well, we have a few minutes left here, so I always like to end, a little bit lighter and more fun. So, do
Yeah.
you have a favorite sports team and or hobby?
Yeah, so I'm from the UK, so rugby is a really big thing here. Todd, do you know about rugby or do you watch rugby?
I do not watch rugby. I have before, but
Yeah.
I'm more of an American football fan. But rugby is basically American football without the pads. It's
And
some
a lot
different rules,
shorter. Yeah,
but
yeah,
yeah,
yeah. And a lot shorter as well.
yeah.
But yeah, so I live in Bath in the UK, and Bath is one of the top European teams of rugby. And so that's my favorite team.
Tell us one surprising thing about yourself.
Oh, surprising. Well, I guess I say this to most people. I write a newsletter on private credit. I've been writing it for the last 3 years every week without fail. So yeah, that's probably the most surprising thing about me.
One book that you would recommend reading.
Oh, I'm currently reading a book called Breakneck. It's about the rise of China. Really would recommend it.
Most exciting part of, I would say you can do this one of two ways. Most exciting part of your day job or the most exciting part of writing the newsletter. You
Oh, I
pick.
can say both. Yeah, yeah,
Yeah, yeah,
fine.
use both.
So,
There you go.
from my job, so I'm a portfolio manager, head of portfolio management at Claret Capital Partners. We are one of the largest institutional private venture debt funds in Europe. And one of my best jobs is meeting lots of venture-backed businesses that have exciting ambitions and working with them, lending them more money. We recently reinvested to a satellite business called Open Cosmos, and they're sending CubeSats and doing some amazing things in space. So that's the exciting thing about my job. I think the exciting thing about my newsletter is meeting people like you, Todd. Learning more about private markets. You know, that's opened a lot of doors. I get to meet interesting people like yourself and leaders like Joel Holsinger from Aries, and hopefully more and more of these people. So that's definitely it.
And then final question, one prediction for the next 12 months.
Oh, interesting. Um, I would say, oh, what's my key prediction for 20? We were talking about this the other day. I mentioned about this in the car. Um, I think this year we're going to see more and more. I think it's that, and I know it's a bit cliche, but the bifurcation of all markets, right? I think more and more so we'll see the people who um, in the good times lent to far risky credits or invested in businesses that shouldn't exist. And I think more and more we're going to start seeing this bifurcation of right, the people who are sensible and the people who have not. I don't think we've fundamentally seen this in all markets, right? And I think everyone's talked about in last year, I think there was a lot of focus on the likes of first brands. Um, and that's only, and I'm not saying that there's going to be an explosion in like I completely disagree with that, but I am going to see is there's going to be more managers who have struggled, um,
Yeah.
and and in the way what will happen is we'll just continue to see more consolidation. I don't think what you'll see, and this is the really good thing about private credit is assets and liabilities are matched, and so I don't think you see events like an SVB bank run, but I do think you see more consolidation, and these managers will be quietly acquired. buy the larger managers or the niche assets, and you definitely see more of that.
Well, Nick, I really appreciate you coming on the show. I view the the Credit Crunch blog as a must read. So if anybody hasn't yet have it in their inbox, please do sign up. It's a great snapshot of the market, continued success, and keep up the good work with that. And thanks for coming by.
Great. Thanks for having me, Todd. Appreciate it.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.